No, thanks very much to those who've come along. The concept is to talk about the green bond market a little bit, and where we see some gaps. So maybe start with the definition, in case anybody's not familiar, of what the green bond market is. So basically, in essence, green bonds are issued to raise financing for environmental or climate-related solutions. They can be issued by governments, banks, municipalities, or corporations. And in order to be labeled as a green bond, they have to comply with ICMA's green bond principles. The key, really, at the end of the day, is that there's a level of transparency in what the money's going to, and to be able to ensure that the proceeds of the bond are headed towards climate and environmental ends. And that's really what defines them in a way, and being able to track that and measure that and report back on it. It's a market which has seen huge growth over recent years. I think you can see on the chart on the left-hand side there, there's 130 billion issued last year, with just every year continued pattern of high growth, high investor demand, a lot of interest. In 2017, just to throw some numbers out, there were 1,500 issuances in 37 countries on 6 continents, from a total of 240 different distinct issuers. That's from the Climate Bonds Initiative. So it's a really exciting market. The but is that it's still fairly concentrated. So far, most issuances have been from sovereigns, sub-sovereigns, and development banks still dominate in a way. There's been, as you'll see on a subsequent slide, a little bit of increase in diversity. But there's still a long way that corporates and financials have to go in order to really be exploiting this market to the full potential. It's still very much dominated by investment grade issuances. It's and areas which have a high climate potential, such as transport, technology, and products such as ABS, high yield, trade finance. All of these areas which really have a lot to do to contribute towards green finance remain very tiny percentage of the market. Geographically, there's also a high concentration. Basically, 60% of issuances last year were from just 3 countries: the US, China, and France. So there's a lot of room to grow in these other underrepresented areas.
Well, I think the session is really about how we can create green markets in the fixed income space. If you take one step of hindsight on what happened on the green bond market, it was clearly created by multilateral development banks, and hence EIB presence on stage. So it's one very large potential issuers with lots of underlyings aligned with climate goals, EIB. Another one with the World Bank Group. They decided to basically create this asset class. But to create an asset class, it's all right if you have some issuers, but then the market has to support these initiatives. So basically you need to have as well demand for the bonds or the securities that will be issued, and you have standards. And this is what worked well with the green bonds, because in terms of standards, the investment banks came along, and altogether they sit to design the green bond principles. And progressively, the demand side started to step into the game. So progressively, you saw some institutional investors basically expressing specific demand for green bonds. And to give you some feedbacks of what we've done, I'm part of Amundi Group. It's the largest European asset manager with a very strong focus on SRI. And we went step by step, basically, to continue to grow with this market. First step is investing into the securities to put them in our regular portfolios. Second step, slightly trickier, is to develop standalone strategies to really try to exploit what the security has to offer in terms of potential. So we develop green bond strategies. And then third step is to be more proactive in terms of developing markets. And this is where we've been very glad to be selected by IFC, part of the World Bank Group, to extend the green bond universe to emerging markets. So that's what the green bond market was. And we are trying together with the IFC thanks to the support of EIB as well, who is an investor into this program, to support the growth of green bonds in emerging markets. And to do so, we have a kind of holistic approach. We address the demand side by setting up the largest green bond fund ever with 1.4 billion. IFC addresses the supply side by providing technical assistance facility to issuers. And we also work on standardization, right? Because we have an ESG charter that basically publicly says what kind of green bonds we like and what we don't like. And we have a scientific committee to advise this standardization body, if you wish. And so if you take this example of emerging markets back to what we could do in Europe, then maybe we have interesting leads in terms of what we can develop.
Yeah, and thank you. So I'm going to jump back now to where I probably should have started, which is why Europe? Why am I up here interested in Europe? So as you heard, I'm here representing EIB. We're the largest multilateral lender by volume, actually, based in Luxembourg. And 90% of our business is focused on Europe. We do significant business outside of Europe, and we were very pleased to participate in the fund that targets emerging market green bonds that Timothée was just mentioning. But really, we have a very high interest in working in Europe. Just to give you, some brief stats about EIB. We've made a pledge that 25% of everything we do and 35% outside of the EU is going to be dedicated to climate. We've provided over 90 billion over the last 5 years to climate finance and plan to do the same again over the next 5 years. And we really have a strong interest in the green bond market. Through our climate awareness bond, EIB was actually the first entity to issue a green bond back in 2007. So last year was the 10-year anniversary of our first issuance. And during those 10 years, we issued 18 billion euros of green bonds, climate awareness bonds as we call them, including benchmark issuances in euros, USD, and sterling. And we've also had a really important role in market development through really establishing a best-in-class reporting framework and facilitating and spurring market dialogue between all the important actors. So we're really interested to see where are the gaps in Europe and what can still be done here. So back to Timothee's launch point. Europe's had a very central story so far in creating this market. The European banks are very active underwriters. European asset managers were the first, in fact, to create dedicated funds focused on green bonds. And about a third of all global issuing entities are actually, to date, European. But, as I mentioned earlier, to go back to the theme, the market is still quite concentrated. We're still talking primarily investment grade, sovereigns and sub-sovereigns, and really the top blue chip companies. So just to put it in some context and to give a sense of the size of the potential market as we see it, labeled green bond issuances in Europe last year were just shy of 60 billion. And that compares to the EU 2030 climate objectives, which call for about 180 billion, so over 3 times that amount of additional funding every year. So there's a very big gap to close, and we see that there are these non-filled parts of the market, not satisfied parts of the market, which can start to be addressed.
Well, so just to come back on the green bond market in Europe, so this is where we are. And we're only there. We have large corporate, sovereign, sub-sovereigns issuing green bonds, and there is a question of additionality. It's a very interesting tool because we can engage them, and we can understand better what are their climate policy linked developments. But to be fully successful, to fast-track the transition in Europe, we need to address all of this, to really reach out to all the sub-segments of the European economy. So it means that we want to develop green private markets with basically mid-sized companies issuing potentially loans or bonds. So that's true for Euro PP. We want to see green loans. We want to see Schuldschein, non-rated issuers. You want to see as well more high-yield green bond issuer. And this is where you can really make a difference by investing into a green bonds. Because the nominal issued by a high-yield issuers every year is far smaller. So if they issue a green bonds, it means it can make a difference, basically to help them increase their green investment, a lot more than for investment grade, actually. You want to see as well the securitization market, all the securitized credit to be more green. This is where you can make a huge difference in terms of green the real estate, green RMBS, speed tracking the transformation of the auto industry. You have auto ABSs as well. You want to reach out to the small and medium-sized enterprises. You can think about green CLOs as well. And to really to be more impactful while creating market, you can really learn the lessons from what happened on the green bond market over the past 12 years and try to apply that across the fixed income spectrum. So again, if you remember the three sort of key items that I highlighted to have a successful creation of the market, is that you have to have supply. So you need to work with the companies to have them issue green assets. You have to work with investment banks that will be active in making it happen. You have to have a demand at some stage, specific demand that will be interested to invest into these securities, and you have to have standards. You can start the market by having only two of these three items, but at some point you need to have the three, to have like a well-structured market with sustained volume of issuances. And then the question is for everyone, is based on the green bond experience in basically listed public bonds based on the IFC program to kickstart the development of green bonds in emerging markets. What can be done, basically, around this trinity to develop the green part of these other sides of the fixed income market? And just stop there.
Thank you both for your pitch. I think you managed to condense quite a lot about the opportunity as well as what EIB and Amundi are doing together to help move this issue forward. I don't want to get in the way. I just would like to open the floor to any questions from the audience.
Hi, I'm Michael Aslan from Frontier in London. I wanted to ask, I'm not an expert on the green bond market. I read about and watched a video clip about the forest bond that was issued, where I think it was 130, 140 million was raised, and the investors were offered either a 1.5% cash coupon or carbon credits from the underlying forestry project. And at the time, the EU unit was very low in price. All the investors went for the cash coupon. No one went for the underlying carbon credits, perhaps understandably. But are there any other examples like that where now investors are accepting a combination of coupon and carbon offsets as their return on a green bond?
Maybe I can start just by providing the view of an asset manager whose role is to manage assets and sell funds. I think it's a very interesting idea, but then the question is what investor base you're targeting. Is it the traditional, conventional investor base, or is it the much, much smaller investor base of impact investors? If you are targeting a small size strategy for impact investor, it's perfectly fine. If you want to reach very, very large size to have an impact at scale on the market, then maybe to need to stick with more conventional type of financial securities. And the good thing about green bonds is, first and foremost, it's a bond. It's a fixed income security, so investors know about it, they feel comfortable to invest in it. If you do a green ABS, it's an ABS, right? In terms of like financial profile, return and risk. And so I think it's a question of trade-off and what kind of investor base you are targeting and the kind of size, Yeah.
And I would emphasize the same point, right? That you can come up with, and I think people are coming up with all kinds of exotic, interesting structures for financing. At the end of the day, though, a green bond, and really the reason it's powerful as an instrument is it slots right into an existing market. It is basically just a bond in any of the flavors that we can see here, any of the formats. But it's a bond where existing investors, you're investing in the same kind of instrument, but this time you know that what you're doing is destined towards financing climate or environmental outcomes. But it doesn't have to be, and the vast majority of cases isn't anything exotic, and that's why it's powerful, because if there is definitely a market for these more, interesting and bespoke situations, but it's going to be a long time before you're able to convince large asset managers, pension funds and so on, to really pursue that market. This is something which is very much fits with what those institutional investors already know and can attract very large amounts of money already today. So it's quite mainstream in a way, and I think that's one of the reasons it's so powerful.
Hi, Maya Brahman, World Bank. We had Adrian Orr, who is, of course, from the New Zealand Pension Fund, saying that one of the things he'd like to see is more plug and play among the multilateral development banks. Have you had any thoughts on how one might go about that with standard products across the MDBs?
I hope I didn't benefit from hearing this the comments, and so I'm not sure that I fully understand what you mean by plug and play.
What he said was, we don't. I mean, our investments are interesting, but they're not standardized as you'd have a certain class of assets that you could invest in. It's not standardized products like buy climate, say. And so he was suggesting, this will take time to develop, but it was a question I had for you from the EIB perspective. Is this something they're looking at to attract some of these large institutional investors?
Yeah, I think, and Timothy, jump in if you want. I think in some ways at the moment, the bond that's being issued is defined by the underlying risk, the characteristics of the risk, so the risk profile of the corporation that's being issued, the risk profile of the portfolio of assets that's underlying it, and so on. In that sense, it is fairly standardized into different market segments, different formats for the debt, which are all quite well known. I guess maybe you're talking about more sector-based. Is it more so that you'd have specifically a transport bond or something like that? They do exist to an extent in that if you have bonds issued by a corporate which does renewable energy, it is a renewable energy bond inherently. Likewise with the transport. I know for us, for example, our issuances they're in a few sectors, but it's not broken out. Chris will correct me if I'm wrong, looking at my boss back there. It's not broken out into specific sectors. Maybe that's something that would be of interest.
But maybe to add to Daniel's point, you can see it at the sector level, but you can also have a different view on that issue. Is that will you offer investors the exposure to the balance sheet of the MDB, or do you want to basically put the risk outside your balance sheet? It's very easy to find standardized product with the risk to the balance sheet of the MDBs, and we see that basically with green bonds, right? Maybe you will have sustainable bonds, but it's a standard product in terms of financial profile. Then when you get into the more like structured product, right, to put some risk of your balance sheet and increase then your investment going forward, this is where it's a different investment universe, because you will find very different risk appetites for the different investors. And if you compare the different MDBs and the kind of areas where they invest, and is it a bankable project? Is it non-bankable project? Is it subsidies? Are we talking about sub-Saharan Africa, or are we talking about Southeast Asia, where investors are much more comfortable? So of course we are talking about MDBs, but basically what they do is very different to a certain extent. And then if you want to put risk off your balance sheet, then you have to take into account basically the specific request of investors. And it's working. I mean, it's work in progress, but you see IFC with the MCPP program, you have EIB supporting some funds, and we will see more of that. But it's work in progress for institutional investors to work with MDBs, I think.
And I guess, look, if this trend continues and you do get more corporate, more significant exposure through corporates, that is inherently, naturally, a way of picking sectors, or, you know.
Hi, I'm Bella Tonkanogi from Climate Policy Initiative and the Global Innovation Lab for Climate Finance. And I was curious, I think you made a comment that a lot of this is about, say, traditional financial products, but sort of greening them, right? Or offering, I mean, what's innovative about a lot of these financial tools is not the structure, but actually the use of proceeds and the geography where, many are focused on developing countries, which institutional investors are risk averse about, let's say. So I was just curious if you have any recommendations for bringing these types of products to institutional investors, especially when, even if it's sort of a standard product, how to kind of get them to take that first step or be the first one to invest in something like that?
I think we have just one good example with the fund we just launched with IFC, right? It's so I mentioned this 1.4 billion funds really dedicated to support the development of green bonds in developing countries. It's global emerging markets, so it can do frontier markets, it can do like more developing countries. And the way IFC structured this program to onboard institutional investors that are usually a bit more risk-averse was to work with us to design a layered capital structure where IFC, alongside other MDBs such as EIB or EBRD, are taking a first loss position. So if there is like a loss linked to a credit event, this tranche will be impacted. And then we have senior tranches in the fund that are really dedicated to institutional investors that are more risk averse. Then it's always a question of what's the right balance between the return and the risk. And risk is not an issue in itself, right, for investors. It's if they get the right returns for the kind of risk they face and they feel comfortable with this risk, it's perfectly fine. You want to sell this kind of fund to emerging market investors, they have to invest into emerging markets. They're from emerging markets. So it's always, finding the right balance. But with this sort of, it can be credit guarantee, it can be a first loss position in a kind of layered capital structure. You have actually innovation coming from MDBs that are working and have been successful into attracting institutional investor money. Insurance, pension funds, really conventional investors you will see in Europe and elsewhere.
And I think in a way you hit upon, that's the whole point of the fund that Timothée is mentioning between IFC and Amundi, in which we invested. And it's, others are developing similar structures, and that's kind of the whole point. It's a way of getting investors who maybe aren't significantly in emerging markets, especially not green bonds in emerging markets, maybe in the future aren't exposed to some of these different debt formats, and it's a way of sort of getting their feet wet and getting them comfortable with some first loss, with a slightly more protected environment, let's say, in some ways, and getting some experience and some comfort, which then hopefully will result in a much bigger scale up and entry into these markets.
Maybe if I may, you touch upon the very rationale for public-private partnership. There are things that we can do on our own, and we are sometimes successful in doing it, sometimes less so, but we don't need capital from public finance institutions. And whenever there are markets that are very hard to address, this is where maybe you can start to think about partnerships where the public institutions can basically fill some of the gaps that we cannot fill. It can be a risk sometimes, but maybe tomorrow it's going to be liquidity. I mean, you can find many reasons for an investor not to invest into this market. And then maybe public financial institutions can come, and because they will be ready to take on some of the risk others cannot take, then you have a successful program and a successful public-private partnership.
We have 2 minutes left, so I think we have one more question queued up, but let's keep in mind we've got 2 minutes.
Yeah, hi. I'm with the International Solar Alliance that's trying to get 1,000 gigawatts in the next 12 years into markets where there's currently no investment. These are the most difficult markets. So we are madly trying to get groups of investments to present to investors. And my question was, do you think that there's any appetite going by beneficiary, or is it rather by sector, or is it rather by type of energy access versus utility-based connection? I mean, how does the investor... And by the way, I should mention that EIB is one of our partners, so we will be hunting you down and coming to look for you.
I would say, as an institution, we do have specific preferences for sectors, for what's being financed, for geographies, and that's all wrapped up in terms of what we can finance and what's an asset that we, at a political policy level rather, aim to finance. So all of that's very important. This is working. Yeah, I guess from the perspective... Yeah. I mean, from the perspective of how it's packaged, what the financial instrument is, again, it comes back to what I said earlier, and I think Timothée was referring to it. It's the credit profile of whoever or whatever is behind it. So if it's underlying solar projects with a large corporation standing behind it, it's in a sense, it's what defines it is that large corporation that's standing behind it. If it was a government or sub-sovereign entity that's standing behind it, that's going to define in a way what kind of bond it is. And if it's instead a portfolio, the actual it's an asset-backed security, for example, the assets and the risk of those assets. So in the sense of solar, it could be solar installations themselves or a pool of receivables or something, but that in the end is what creates the risk profile, and that's what defines the instrument. I don't know if you want to add anything.
I think that's a good way to wrap it up. I missed a couple of hours earlier today, but I mean, we have a really good audience for this pitch hub. And I think that's a testament to the leadership that EIB and Amundi have in this space. There's a lot of people interested in watching how this fund plays out and how this helps push the market forward. So we promised you a dynamic pitch hub, and it is very dynamic. I picked up, Daniel noted it there's a lot going on in this room. So thank you guys very much for delivering a really compelling pitch, and hopefully you have a good rest of the week. Thanks, guys.
Thanks.
Thank you.